Yo, it's your boy Felix. Welcome to the first video of my YouTube channel, and in this video it will be on market structure. So if you like what you watch, don't forget to like, comment and subscribe, and see you guys there on the chat. Today's video will be based only on price action. For those of you traders that make use of indicators, I'm not saying what you're doing is wrong. If your strategy works for you, it's fine. But I believe to have a comprehensive understanding of the assets you're analyzing and to take your trading game to the next level, then being able to trade using only price action is very, very important. What is price action? Price action just shows the interaction between the buyers and sellers, or it shows the relationship between the demand and supply. Because when you have the buyer in the market, it's always a demand in the market. And when you have sellers in the market, it's always a supply. So if you have the buyers and the seller, automatically demand and supply is already created. So that's what moves the market. So not indicators. A lot of people think, oh, by having this MACD indicator, RSI indicators, this is what pushes the market. No. What moves the market is simply the demand and supply in the market, the ratio between demand and supply in the market. If demand is high, the market goes up. If the supply is more, the market goes down. That's what moves the markets. And there's several ways of representing price action. If you go on your trading view, you have bar chart, Japanese candlestick, holo candlestick. There are a lot of them, but the ones I usually make use of is the Heikin-Achi, the line graph, and the Japanese candlestick. This Heikin-Achi and this line graph, you don't need to worry about it right now because I will make videos about them in the future. But the one I usually make use of is the Japanese candlestick, which I'll be using today in today's video. Now, the next step is what's market structure. When there's a buyer and a seller in the market, the interaction of buyers and sellers in the market usually leave a pattern. And this pattern is what we call market structure. So you might, when you see a graph, you may think, oh, the graph is just random. There's nothing going on there. You can't really study the graph. No, it's actually like a pattern that shows interaction between buyers and sellers. Let me give you an example. Look at this market. Look at this. This is the monthly time frame. You can see there's a pattern down here. And this pattern is what I'll be discussing today. This pattern is what we call the market structure. So your ability to the market, how does the market move? A lot of people think the market move in a straight line just because the news says that a certain asset or a certain stock is doing very well. Then it's gonna like move from point A to point B in a straight line. And it doesn't move like that. The market moves in waves, up and down, up and down, up and down. Sometimes it can consolidate and so. So the market has three phases. There are three phases you can see the market. Any market you see or any chart you see, there are three phases in the market. Either the market is going upwards, so it's a trending market. There's an uptrend where the market is making higher highs and higher low. So this is a high and this is a low, this is a low and this is a low. This low is higher than this low. This high is higher than this high. So if the market is making higher highs and higher lows, you're in an uptrend. This is the first phase you can see the market. Second phase you can see the market is the market is making lower lows and lower high. So this is a high and this is a high. This high is higher than this high. This low is lower than this low. So this is a lower low and a lower high. This is lower low, lower lows and lower high. So it's a downtrend. So when the market makes lower lows and lower high, it's a downtrend. The third phase you can see the market in is in a ranging market. So let the market the market is going up and down between 2 points. So you can see this area acts as resistance. So the market doesn't go above this region. So you can, and similarly for this downside, which acts as area of support. So these are low, these are all low. So you all have equal lows. Sometimes in a real market case, you can see the market could move a bit slightly below this or down there, but it's still a ranging market. As long as you don't see a massive move where the market break the structure in a massive move upward, then it's a ranging market. And a lot of traders trade this market by expecting when the market gets to this region, they buy, and when it gets to this region, they sell. So it's a ranging market. But today's video won't be on ranging market. Will be solely on uptrend and downtrend, because that's where we make the money. That is where, as a trader, you look at probability of your trade, not just placing trade. You look at if you're in a ranging market and the market is making higher highs, higher lows, and you decide to trade in direction of the trend. So you're going in an uptrend, and you trade in direction of the trend. There's a high probability of you making money because the market is an uptrend. And similarly, if you're in a downtrend and you place a sell trade, there's a high chance of you making money because you are trading in direction of the trend. So, in summary, the market doesn't just move in a straight line. It makes higher. It moves in waves, and these waves could either be in an uptrend, a downtrend, or a ranging market. And today's focus will be on uptrend and downtrend. So an uptrend makes higher highs and higher lows, and a downtrend makes lower lows and lower highs. That's the first thing. So now, as a trader, where do you place your trade? Where do you buy? Let's say the market is making this. Let's say the picture we're looking at, we're looking at the graph, and the market is making higher highs and higher lows. In an uptrend, what you should be looking for is to place a buy trade in the direction of the trend. But it doesn't mean that just because this is making higher highs and higher lows, I can just place a trade anywhere around here. No, you have to look for certain areas where the market is cheap, where you can buy when the market is cheap. Because you buy when the market is cheap. Like demand. It just has to be the law of demand and supply. When the law of demand and supply says that when the price is low, a lot of buyers tend to step into the market and buy the market. So the price gets as high as this place down here, you shouldn't be looking at buy. Your plan is you want to wait for the market to retrace, because a lot of buyers that bought the market when the price was low have made their profit and they want to let go of that trade, and that's what made the price to go down. So really, you should be expecting where you should be taking trades, buying trades should be around this region. So buy where the market is considered cheap. A retracement, you buy. And retracement, it breaks the structure. At this area, the market is expensive because the price is high. Similarly for you, the price is high. So in a downtrend, your main aim should be buy, supply. Sellers sell when the price is high. You don't sell when the price is low. You sell when the price is high because you bought the market when the price was low, and now you want to sell when the price is high. So for sellers, even though this is a downtrend, you don't just place a trade in a sell trade or sell because it's going down. I'm just going to place just a sell trade anywhere. That's where a lot of traders, a lot of beginners lose money. They know where to enter the market, asset on around this area, and the price is high, and you know that if you sell the price is going to fall down to this level. So came down here, and you made the money, you made the profit. So you don't start selling down here, because if you sell down here, you'll be in a massive drawdown. Imagine selling down here, the price will then go up. Once the price, if you start selling down here, the price start going up. You're in a loss, you're in a drawdown, and depending on your lot size, you might be in a massive drawdown. So you wait for the price to give you confirmation that it's going down, and when the price is high enough, before you take a sell trade. But in the downtrend, what you should be really looking at is just only sell trades. Only sell trades. In the coming episode, I will explain more on how to enter your trades, how to use confluence when making this decision. But in this video, just a brief introduction of market structure. So this is what you're going to see in any chart you're seeing: an uptrend, a downtrend, or a ranging market. So that's the first thing to do. So when giving a chart, the first thing always is to go up to the highest time frame and look at the overall perspective of the market. Is the market making higher highs, higher lows, or is the market making lower lows or lower highs, or is the market overall, is it moving in a range? So the three phases you can see the market. A lot of people think the market is random, but it's not random. This is what you can see within the market. Now, the next stuff I'm going to tell you guys now is Elliott Wave. And after this Elliott Wave, then we'll jump on it. I'll take two examples, and that's it for the video today. The Elliott Wave, it's very broad, but I'm going to summarize it down here. Just summarize what Elliott Wave says. It's very broad, but this video is meant to summarize and cut it down for you guys to understand what Elliott Wave is all about. The Elliott Wave is used in a trending market, so in an uptrend or in a downtrend, like what I said. You never use the Elliott Wave in a ranging market. It doesn't work in a ranging market because there's a different trading techniques when trading the ranging market. But the Elliott Wave is used in an uptrend or a downtrend. You never use the Elliott Wave in a ranging market. Just to summarize the Elliott Wave, it says that in an uptrend or in a downtrend, the Elliott Wave move in 5 waves. So this is an uptrend. This is the first wave, second wave, third wave, fourth wave, and the 5th wave. So it moves in 5 waves, an uptrend. Vice versa for a downtrend, it moves in 5 waves. First wave, second wave, third wave, fourth wave, 5th wave. So this is an uptrend. This is the first rule. So wave 1, wave 3, and wave 5 are called impulsive waves. Wave 1, 3, and 5 are called impulsive wave. And wave 2, wave 2 and 4 are called corrective wave. So wave 1, wave 3, and wave 5 are called impulsive wave. Wave 2 and wave 4 are called corrective wave. This law applies for both uptrend and a downtrend. So for an uptrend, the wave 1, this is wave 1. Wave 3 is this, and wave 5 is this wave. They're called impulsive wave. So if this is an uptrend, why are they called impulsive wave? They're called impulsive wave because they move in the direction of the trend. Remember, like I said, when taking trade, what I said earlier, when taking trade, you take trade in the direction of the trend. Why? Because you have a high chance of making more profit. You have a lot of people taking trades in direction of that trend. So basically, you expect a bigger move when you take trades in direction of the trend. So wave 1, wave 3, and wave 5 are called impulsive wave because they have the biggest wave in the market. Why wave 2 and wave 4 are called corrective wave? Because they move against the trend. They kind of counteract the trends. They move against the trend. So really, you shouldn't be taking trades around this region. You should wait for the market to pull back, and at the end of the 4th wave, you take a trade. Similarly, for this second wave, you wait for the second wave to be exhausted, and you take a trade at the end of the second wave to capture the 3rd wave. So wave 1, wave 3, and wave 5 are areas where you should be looking at placing trades for an uptrend. Similarly, for a downtrend, wave 1, wave 3, and wave 5 are impulsive wave because see the direction, they move downwards in direction of the trend, and they have the biggest move because you have more people interested in these waves than in this corrective wave that goes against the trend. So you can see this is an overall downward trend, and so the smaller wave in a downtrend. This wave 4 and wave 2 acts against this downtrend. So really, why should you be trading against the trend? You can trade against the trend, but you need some level of understanding to trade against the trend. So Now, the impulsive wave are always in a 5-wave pattern. That was, the impulsive wave are always in a 5-wave pattern. So I said wave 1, wave 3, and wave 5 are impulsive wave. The fractals are always in a 5-wave pattern. A lot of people say, what's a fractal? The example I always give my students about fractal is that imagine you're peeling an onion. When you peel an onion, inside the onion, you see a smaller replica of the bigger onion. So you keep on peeling an onion, you see a small replica inside the onion. That is how it is for an Elliott wave. Like, for example, the impulsive wave is always a 5-wave pattern. If this is a first wave 1 of this impulsive wave, is an impulsive wave, you can also get a smaller 5-wave pattern within this impulsive wave. So impulsive wave is this 1, 2, 3, 4, 5. And also here as well. 1, 2, 3, 4, 5. Similarly for a downtrend, or the direction is different. 3, 4, 5. So the third impulsive wave is this 1, wave 3, 2, 3, 4, 5. And the fifth impulsive wave, the wave 5, which is an impulsive wave. So if you notice, I only drew the 5-wave pattern for the impulsive wave, while the corrective wave, which are wave 2 and wave 4, I didn't draw anything for them. Wave 2 and wave 4 is left blank because they have the way of the fractals are represented in a different way. Before I go to the corrective wave, one thing else you must also know is that in a 5-wave pattern, in a impulsive wave, the third wave is usually the biggest wave and it's never the smallest out of the 3 impulsive wave. So wave 3 can never be the smallest wave out of the whole 3 impulsive wave. Most cases, they're always the biggest move, but that's where a lot of traders want to trade, financial institutions and hedge funds and all of them want to always trade the third wave because it's usually the biggest wave, but it's never the smallest wave. Wave 1 can be the smallest wave. Wave 4 can be wave 5 can be the smallest out of the 3, but wave 3 can never be the smallest. When you see a wave 3 is the smallest wave, then you have to recount your Elliott wave to make sure you're taking the right count of the wave. So corrective wave, how are they represented? Corrective wave are wave 2 and wave 4, wave 2 and wave 4. Corrective wave have an ABC pattern, which is a 3-wave pattern. So it's, like I said, you have various, Elliott wave is very, very broad. So what I'm doing right now is summary. You don't have to you don't have the time to read through everything of Elliott wave. You can just use this video just to summarize the Elliott wave. If you have this understanding of Elliott wave, trust me, this is just what you need. This is the basic foundation of Elliott wave. The corrective wave are in this pattern, then an A, B, C pattern. And you have 2 ways you can see the corrective wave, 2 major ways you can see the corrective wave. 2 major ways. There are other ways, but these are the 2 major ways always present itself. A, B, C. So now, the A wave, A wave could either be a 3-wave or a 5-wave pattern. The B wave is always a 3-wave pattern. The C wave is always a 5-wave pattern. So A wave could be a 3-wave pattern or a 5-wave pattern. The B wave is always a 3-wave pattern. It doesn't change. It's always a 3-wave pattern. The C wave is always a 5-wave pattern. Get it? So if I'm to draw this here, this is where you can see the correction. So the first way you can see it is 1, 2, 3, 4, 5. The C wave is always the 5-wave pattern. Always a 5-wave pattern. And the B wave is always a 3-wave pattern. It doesn't change. Always a 3-wave pattern. Is A, B, C. Right. The second way you can see the corrective wave is that the A wave is a 3-wave pattern. The B wave is always a 3-wave pattern. And the C wave is always a 5-wave pattern. It doesn't change, always a 5-wave pattern. So if I go back to the same drawing and I put this in here now, so this is A, B, C. Three wave pattern A, B, C. So the corrective waves always the corrective wave at A, B, C pattern, 3-wave pattern. So within the 3-wave pattern, you also can zoom in and look at the fractals. And within this 3-wave pattern, so this is A, B, C. If you scale in, what you're gonna see is you could either see a 5-wave pattern on the A wave, A, B, no, 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4, 5. So if you scale in, what you're gonna see is this, or you can see a 3-wave pattern of A, B, C, 1, 2, 3, 4, 5. So that's if you scale in. So scaling in means going down to the lower time frame. So let's assume we're on the monthly time frame. This is what we can see. So if you scale into the lower time frame, you can get more information about what's happening. You can get more information about the fractals. You can see clearly the market. So if I complete the other one, is A, B, C. A, B, C. So in summary of everything, use Elliott Wave in an uptrend, in a trending market. So the market is either making higher highs and higher lows for an uptrend and lower lows and lower highs for a downtrend. You never use Elliott Wave in a ranging market. Secondly, the Elliott Wave makes a 5-wave pattern in a trending market, which I showed you guys. Thirdly, the impulsive wave, which moves in direction of the Elliott wave, in direction of the trend, are wave 1, wave 3, and wave 5. And the corrective wave are wave 2 and 4. Wave 3 is usually the biggest wave, and it's never the smallest wave. It can never be the smallest wave. The corrective wave gives a 3-wave pattern. And if you zoom into the fractals of this 3-wave pattern, the wave A could either be a 3-wave pattern or a 5-wave pattern. The wave B is always, it doesn't change, always a 3-wave pattern. And the wave C is always a 5-wave pattern. So with this information, I think we can jump right into the chart where I'm going to take 2 examples and show you guys how to analyze the market structure. Just a brief introduction into my analysis of the market structure. Let's jump right to the market.